People who invest in the stock market assume that their money is going to grow at 10% rate forever. And this can feel like a wild assumption if you don't understand why the market is going to continue to expand. I often found that if I'm unsure about something, the best way to clear up the uncertainty is to gain more information about a certain statement. So in this video, I'm going to break down all the factors contributing to continuous market growth so that if you're unsure about moving your money from a traditional savings account to an investment account, after watching it, you'll feel more confident and understand the reasons behind this set expectation that many people continue to rely on. There are several factors contributing to market expansion, and we'll start with the first one, economic growth. The stock market often represents the state of the economy. So when the economy is doing well, businesses tend to do really well as well. This means that people are buying more things, so increased consumer spending, and businesses continuing to invest in the business. When companies earn more, their stock prices increase, contributing to the market growth. Second factor is innovation and technology. We live in an era of a rapid technological advancements. We're seeing this innovation not only in the tech sector, but also in the renewable energy and healthcare. And as companies respond to innovation, they tend to create more products or services to meet the evolving consumer demands. These innovative companies tend to capture a larger market share, which means that they generate more sales. And as they generate more sales, they make more profits. And with more profits, their stock price goes up, contributing to the overall market growth. At number 3, we have increased investments from institutions and individuals. In today's world, more people are investing than ever before. Many of us have 401k accounts set up by our employers, which encourage consistent contributions and a long-term perspective when it comes to investing for retirement. On the other hand, institutional investments, that's pensions and mutual funds, bring in large amounts of capital to the market. All of that encourages investment and is another factor contributing to the market growth. At number 4, let's talk about the role of the government in the growth of the stock market. The main function of the Federal Reserve is to regulate U.S. monetary policy, manage interest rates, control inflation, and ensure economic stability. So when the interest rates are low, borrowing becomes cheaper, which encourages spending across multiple sectors of the market by both individuals and institutions. Additionally, policies that promote job growth and infrastructure development stimulate the economy, contributing to the market expansion. Another important driver for market growth is population growth, and there's two sides to it. First, as the population increases, so does the demand for goods and services. This drives businesses to expand, hire more workers, and invest in innovation to meet the rising demand. In turn, as these companies grow, their stock price increases, driving the company value up, and in turn driving the market value up as well. A growing population means that more people are entering the stock market, and there's an influx of capital into the stock market as long as the population keeps growing. This continuous cycle helps support the continuing expansion of the market. There are some key periods in history that further illustrate these reasons for the market expansion. After the World War II, in 1950s, the period was marked by rapid industrial change and population growth. And you can see that S&P 500 grew at about 16% during the 1950s. Another key time period was the technology revolution in 1980s to 2000s. The rapid advancement in internet and personal computers didn't just affect the tech sector, but it completely reimagined how we bank, how we do healthcare, and how we do retail. This is reflected in the market growth of 17% returns year over year during that time period. Another key period is the period post-Great Recession, so after the 2008 crisis. The economic recovery of that time was supported by low interest rates, which made borrowing cheaper, causing businesses and consumers to invest more in businesses, spend more money, and drive the market up. Looking at the S&P 500 performance of the time, it was going at 13.6% annually. I hope that this video helped you understand the reasons behind continuous market growth and made you feel more confident keeping your money in investments or moving your money from your traditional savings account into an investment account so you can capture better returns. Thank you so much for watching. I'll see you in the next video.